Hello again, kids. One of my favorite times of the year, we're doing the Tokio-Marine HCC annual stop loss report. I've done it the last 2 years in 23 and 2024. Very well received by the market, very fun to do. And to the credit of Tokio-Marine HCC, they actually sent it to me again this year and said, hey, will you please do one of those videos? And I was happy to oblige. Not only do I like the company, sat down with Jay Ritchie here recently as well for a podcast, but also they're a partner of Pareto. And so I love this kind of stuff as a stop loss geek, and I'm hopeful that you guys will gain something in terms of knowledge from listening to me do this review. We'll link this in the post where you can see the actual report. Would strongly encourage you guys to go read it in its totality, because all I did was pick 5 key takeaways like I normally do of things that stood out to me that I thought were relevant to highlight. But you're going to be missing a lot of context. There'll be some of the graphs that I had to shorten in order to fit on the screen. So I'll make sure to send you that link so that you guys can read the whole report. But here are my 5 key takeaways. So we're going to look at diagnostic categories. Every single year, Tokio-Marine highlights the most expensive categories and the most frequent large claims categories, and so do other stop-loss carriers as well. And you'll often see there's a lot of overlap in the categories themselves year over year and across those carriers as well. Then we're going to look at large claims. One of my favorite things to look at, although it means this costs a lot of money, but we're going to look at frequency and severity of large claims at different thresholds as well. Third, the cost of COBRA. And I don't mean the cost of actual COBRA equivalent rates. I mean, how much do claimants who elect COBRA cost more on average than your active employees do? Laser frequency is next, so looking at the frequency of like what percentage policies have a laser on them, and then on average, how many lasers are on policies that have lasers as well. And last but not least, we'll look at loss ratio maturity. I always like to pick a category that's a little bit difficult to explain. This is the first time that I've seen HCC highlight loss ratio maturity, which is at different points in time. What was the loss ratio at this moment in time, and then how does it complete? But I think it's really telling and it's insightful when it comes to renewals. So we'll highlight that as the last 5 key takeaway, okay? All right, so let's look at diagnostic categories first. And this is frequency. We'll move on to severity next, but right now we're looking at frequency. And if anybody doesn't know what I mean by that, frequency is how often do these categories end up in the top 10, okay? And so no surprise here, anybody that's seen a report like this before knows that neoplasms and cancer are always the most frequent type of disease state within the top 10, and that has remained true for the last 4 years, and I suspect it will likely remain true for the foreseeable future as well. Same with cardiovascular diseases, okay? So no movement whatsoever, and actually no movement in terms of frequency in the top 4 categories, interestingly enough. Number 3, which is often, I think, missed by a lot of people, musculoskeletal connective tissue diseases. These things end up being a lot more costly than people think. And so that's showing up as number 3. Digestive diseases, these are things like IBS and Crohn's and other diseases of the stomach that have a lot of times costly medications associated with it as well. And so those round out the top 4. This is a top 10 as well. As you can see, I had to cut it off. The only movement really in the top 5 was in that 5th category. And so obviously back in 2021 with the COVID event that we experienced, respiratory diseases were number 5 in terms of frequency. But that was in 2021 and 2022 and 23. Injury, poisoning, external accidents and causes. I'm assuming that's things like car accidents, slip and falls. Poisoning is probably accidental poisoning. I don't think there was anybody out there going and poisoning people. I don't know. And then this past year, though, the movement in the top 5 category, nervous system diseases. So I suspect that's things like multiple sclerosis, as an example. We see MS all the time show up on top claimant reports because the medication associated with MS is very, very expensive. And so that became now the 5th highest category in terms of frequency for large claims. Now let's go to severity. So severity is a little bit different than frequency. And so you can see the last 4 years, transplants actually in terms of severity by the top 10 categories, transplants have remained static or steady as the most expensive category there is. Then you get some movement now between the second and the fifth top categories, where you have congenital anomalies and you have perinatal kind of going back and forth. So these are things like, malformations, unfortunately, when young children. You'll have premature babies that end up in the NICU for long periods of time. That's actually, for us, last year, that was the most expensive claims that I've ever seen, came out of the preemie or NICU baby categories. And so it dovetails very nicely with what HCC is seeing as well. In category number 4, you have blood diseases now moving up and down between the fourth and third most severe category. Blood diseases, as an example, may be something like hemophilia. So a hemophiliac has a blood disorder where their blood does not coagulate, or it doesn't, close up. So if you got a cut, you would effectively just bleed out continuously. And so they have to take this really expensive, there's a couple different medications. I think there is a gene therapy out there for hemophilia as well. And so that is a very costly and ongoing category as well. And then last but not least, we've got quite a few different diseases in this category number 5. Between infectious diseases, that's probably things like sepsis. You have this purple, which is a random category I've never heard of, factors influencing health status. And then this pink is neoplasms and cancer. So even though neoplasms, cancers are at the top of the list in terms of frequency, they're only in the fifth or below in some instances in terms of actual severity. All right, now let's move on to the frequency of large claims. So what Tokio-Marine is, I have two graphs for this one topic, but we have frequency of large claims over time. So what they're doing on the screen is they're showing back to 2019, but they're actually tracking this all the way back to pre-ACA in 2013 to show the impact that the ACA has had on large claims. And so you see in purple, we're looking at a threshold of $200,000, which in today's terms, not a very expensive claim. And then in blue, we're looking at $500,000 claims. And so you can see the trajectory. I won't go to bullet by bullet, but you can see in terms of $500,000 claims, those are up 250%, let's call it 2.5 times since 2013. And so you're seeing a lot more frequency of these larger and larger claims. The $200,000 category is only up about 150% over that time. But I wanted to show this screen because the next screen I think is more shocking, right? These are large claims. And if you read Tokio-Marine's report, we talk about this as well. Large claims have had to be redefined over the last few years. I used to think a $500,000 claim was a catastrophic claim. These days, $1 million isn't necessarily even considered a big claim in today's terms. More the $2 million point is where we're actually seeing it called a large or catastrophic claim. So what you're seeing is, again, tracking back to 2013, the $2 million, which is in pink, is up 1,250%. So 12.5 times more frequent to experience a $2 million claim. This is transplants. This is the cost of cancer. This is gene therapies. This is NICU babies, dialysis, things like that. All of those are leading to a huge uptick in terms of the cost of the claim itself. This is pretty shocking. And I think most people would suggest that the ACA contributed pretty significantly to this, whether it was the medical loss ratio requirements, removal of lifetime and annual maximums, things like that. Whatever the reason is, it's probably idiopathic, as we like to say. The reality is we're in a market, in a hardening market, because of some of these very, very large claims that keep happening more often. All right, COBRA. I mentioned earlier, COBRA, we're not talking about the COBRA rates themselves. What we're talking about is how expensive is a member on average when they decide to elect COBRA. So here we are, this is different thresholds again, 200,000, 500,000, and $1 million. How much more frequent are claims at those thresholds for a COBRA claimant versus an active employee? So 13.5, 13.4, 13.5 for the $200,000 category. 14.1 times more likely to have a $500,000 claim if they're a COBRA claimant. And then $1 million threshold, 15.5 times is more frequent. So what does this tell you? This tells you the people that are electing COBRA are electing it because they need it. If they're going to pay 100% of the premium rather than having it, some of the contributions be paid by the employer, by moving from an active employee to the COBRA option, they probably need coverage. So what would you do? You need a solution. You can't force somebody to pick a different option. They have the legal right to elect COBRA if they need it, and if they can afford the premiums, they're going to be able to be covered. But you should likely have a solution in place to be able to help those members as they transition or are offered COBRA to explore the open market, other options that are better suited for their needs, especially from a cost perspective. And if you can find that solution, and if they voluntarily elect that solution, then you as an employer, a plan sponsor, won't have this risk that is very likely to cost you significant money to be retained by your plan. All right. Loss ratio maturity. I told you we're going to cover kind of a hard concept to cover, but I'll explain it as best as I can. And I think you'll see the reason why I picked this out of the whole report. And so what are we looking at? We're looking at policies with a 50, a 75, and 100% loss ratio at different points in time throughout the year. So 6 months into the policy on the left, 7 months on the policy on the right, and then we're going to look at the 8th month and the 9th month. And so as an example, a policy in the 6th month of the policy period that has a 50% loss ratio at that 6th month, on average will end up, so we'll finish with around a 70% or 76% loss ratio. A policy that has a 75% loss ratio at that 6th month will end up around 114% loss ratio. So what does that mean to a stop loss carrier? They're losing money at that point. And then you can see in blue, a policy that's already at 100% loss ratio by the 6th month, on average ends up with 152% loss ratio. The farther we get along into the policy period, you'll see those curves start to flatten. So as an example, 7th month of the policy period, 50% loss ratio at that point, will end up only at a 70% loss ratio, and on and so forth. So what does this tell us? It tells us the further a policy gets into maturity, so the number of months into that policy period, the further it gets into that policy, the flatter the actual eventual trend or the loss ratio will get. So let me show you. If we look at the 8th month of the policy period, it has a 50% loss ratio at that point. It's only going to end up on average with a 63% loss ratio. And you can see, no matter what loss ratio we look at that moment in time, it's flattening significantly. We get to the 9th month, which is where a stop loss carrier would strongly prefer to renew a case at the 9th month or later. Why? Because they know with a very high level of predictability where that policy is going to end. That's going to help them price it appropriately. The farther you get away from the renewal date in which you ask the stop loss carrier to lock the terms, the more conservative they will have to be, which means the price itself will have to go up. And so they have a really high predictability level at that 9th month. Wherever a policy actually is at that 9th month, they have a very high level of predictability. They know where it's going to end. And relatively speaking, it's not going to get that much worse, so they can do a better job of pricing it for the future as well. All right, last thing, lasered policies. If you guys remember, a laser is just a larger specific deductible for one or more individuals who are named by the stop loss carrier, where their exposure is carved out, and that employer has more risk that they have to incur for that individual potentially, okay? So what are we looking at? We're looking at market high, which is dark blue, market average, which is the light blue, pink is Tokio-Marine themselves, and then you have the market low, which is this very, really faint blue color. And so in 21, 22, and 23, we're looking at the average number of lasers per policy. So on average, the market high was about 2 lasers per policy. The average itself was 0.86. So that means on average, every policy in the market had about 1 laser, okay? Tokio-Marine, to their credit, only about 1 out of 3 policies for them had an actual laser. So whether they're writing larger cases, they have access to better data, they're using captives like ours where there's no new laser provisions that prevent them from lasering over time, on average, Tokio-Marine has significantly fewer lasers that they place on the policy. Some carriers also have higher thresholds of tolerance where even though they know large claims are likely to happen, they'll allow a certain percentage of their premium to be allocated for that. And as long as it stays under their threshold of comfort, they may not laser a policy. And you have market lows as well, which Tokio-Marine, again, to their credit, is very close to the market lows. But this is kind of interesting. Market high, you see 2.5 lasers per policy for the highest, I wouldn't say offenders, but the carriers that do laser more often, they are actually themselves lasering more often at that market high, but the average has remained relatively flat over that period. Now let's look at the percentage of actual policies that do have lasers. And so again, looking at market high, looking at average, Tokio-Marine, and market low. And so on average, I want to focus on that, which is this blue right here. About 1 out of every 4 policies has a laser. Why does that differ from the number of lasers on the policy? Because you might have 2, 3, 4 lasers on some policies and 0 on the others. And so on average, and Tokio-Marine is very close to the average in terms of percentage of their policies with lasers, they just don't laser as much or as often as other carriers might. So you see on average, about 1 out of every 4 has a laser on that actual policy. And the ones that don't laser very much, that's 1 out of every, let's call it 7 to 8 policies as well. I think the proliferation of no new lasers, the growth of captives who have provisions that prevent lasering as well on an ongoing basis is likely leading to a little bit of a decrease in terms of the number of policies that actually have lasers on them. Okay, so that is it. We have some summary information from Tokio-Marine, which is their assessment of what is actually going on in the market, what is driving costs up. And so they're looking at some of the reasons why healthcare costs, so underlying healthcare, not stop-loss costs, why are underlying costs going up? Medical inflation. We've talked about it a lot. Somewhere between 9 to 10% is what we think medical inflation or medical trend is going to be in 2025. And most stop-loss carriers are predicting that's going to continue for the next couple of years before it might crest and come back down a little bit. Supply and demand, you guys can read these. I'm not going to read them all. Advances in medical technology, gene therapies obviously is a big part of that. The post-COVID rebound we'll get into in just a second. That post-COVID rebound is being felt as well. You have lower Medicare reimbursements, which are meaning the commercial sector is having to pay more on average as well, relatively speaking to the public sector. So all of these things combined are contributing to rising medical costs. Now, why is stop loss going up? Well, stop loss in leverage trend, again, is a function of underlying medical trend. The higher medical trend is beneath the stop loss leverage trend, the higher leverage trend is going to be as a result as well. So I hear most carriers, and we're seeing it in the market today, whether you're fully insured or self-funded in a stop loss carrier, both of them are saying costs are going up and renewals are much worse than we've seen in the last couple of years. So whether you're in a captive, on your own, fully insured, we're seeing some much higher renewals than we used to see in the years past, okay? Frequency of large claims, we just covered that. The claims are getting bigger, they're happening more often, and oftentimes they're also taking longer. They're lasting longer in terms of treatment protocols, specialty medications that are coming out that treating diseases on an ongoing basis rather than curing. They're also contributing to that as well. The interesting last point I want to make, and I'm going to read it verbatim because I wanted to make sense of it myself. Many stop-loss underwriters viewed the cost plateau in 2021 and 2022 as credible experience. So meaning they just treated it as normal, credible experience rather than a unique generational event, which it was. It was a once-in-a-lifetime, hopefully once-in-a-century type event with COVID. And so they treated that experience where claims went down dramatically. They just treated that as normal, credible experience. So what does that mean? The market softened dramatically. Rates went down, lasers went away, loss ratios were super, super healthy. People were making money hand over fist, but they didn't treat it as a once in a lifetime event. They treated it sort of as normal, and they treated that experience itself as just regular claims experience on an annual basis. And so Tokio-Marine is saying that artificially suppressed stop-loss rates over the last few years. And so what happens if we artificially suppress, at some point there's a rebound event. We're going through that rebounding event right now, or that hardening of the market, and it's actually boomeranged, if you will, even more severely than most people anticipated. And like it or not, for better or for worse, we're going through it right now. And what is the fastest way to get to the other side of something? We got to go through it. And we got to come up with good solutions to solve these problems, okay? So that is the end of my analysis of the 2025 Tokio-Marine HCC stop loss report. When I send out this video and post the link in the comments, I would love for you guys to read that report and tell me what insights you thought were very, very useful in terms of information that I might not have included in this video. And so last but not least, thank you again to Tokio-Marine HCC for sending this over, asking me to do this video. I look forward to doing this every single year, and so I can't wait to do it again in 2026. Thanks, guys.